Welcome to this new webcast in Bramasol's series on revenue recognition using SAP Revenue Accounting and Reporting Solution. In this webcast, we take a deep dive into 3 different contract change scenarios and show how our AR offers the flexibility for handling each one. For each scenario, Sarah Thompson, Senior Solutions Engineer, will detail the steps involved. Then Jacek Dudkowski, Director of Solution Architecture and Delivery, will briefly discuss what this means in the bigger context. First, let's look at a change in the billing document.
In this scenario, we are going to be looking at how changes in the billing document are reflected within SAP Revenue Accounting and Reporting. Here we have a 1-year contract that has been billed annually upfront. But the customer has decided after the first month's revenue has already been recognized and it has been fully billed, that they would actually like to change it from an annual bill into a quarterly bill. Because the customer has not paid yet, we can go ahead and reverse the full amount of the invoice, and we will create a new one with the portion just for that quarter. Then we're going to see how the system manages those changes from a deferred amount into an unbilled amount. All right, so let's take a look at what that looks like. So here we have a simple scenario. We just have a software subscription over 1 year with one performance obligation, and that gets broken down into that 12-month period. So as we can see, if we scroll down here, we've got our 12 months of software subscription. 5,000 is our total allocated amount broken down by month. And we can see we've already recognized 1 month. So last month, 12 of 2021, we recognized $424 and we've fully invoiced upfront. So what the customer wants is they haven't made any payments. They want us to reverse this invoice, show what that would look like within SAP Revenue Accounting and Reporting, and how those changes would be made. All right, so from here, we're actually just going to reverse our invoice out. So we've reversed out our invoice of the 5,000. We can go back to our revenue schedule and see how that's automatically been reversed out. So that 5,000 is gone. So here, what the system would do is it would automatically come in and make the journal entry postings for that invoice correction. So we're taking that original 5,000 amount that we had out there and the unbilled, and we're reversing that out for what we have already posted into our journal entries. What's important to note here is that nothing has been changed to our revenue. So the revenue has stayed the same at $424,000 posted into our revenue from the point that we were able to recognize that. The invoicing, because this is a time-based performance obligation, the invoicing does not reflect on any of the posted revenue. However, when we do go back at the end and look at the journal entries that were posted, we will see the differences between the deferred, unbilled, back to deferred amounts. All right, so this customer wants to take the invoice now and be able to post it quarterly into our open period, which is this year. So if we come back into our billing document for our customer, we've changed it to a quarterly amount. So we're looking at $12.50 for the quarter. The payment terms are at the end of the quarter. And we can see here that we're looking for our invoice that we're going to be paying now in January, so 1 month after we've already recognized our revenue for the remainder of that quarter. So we'll go ahead and post our billing document here, and then we can see that reflected on our revenue schedule again, but instead of the 5,000 in month 12, we're now going to see the $12.50 posted here. So we're going to go ahead and recognize our revenue for the month and see how that all gets reflected into the deferred and unbilled amounts that are still out there. All right, so we've now come in and we've got our revenue contract here ending in 12427. So we can see for the month of January, we can actually take the invoice correction amount, so that $12.50 that's out there, make the adjustment for the unbilled amount because we have billed for December, and then our new revenue that is out there. So the receivable adjustments and the deferred amount that now gets posted for this month's revenue. Once we post this, we'll actually be able to go in and see the journal entries that have been created by each month. Quickly, one more time before we see the journal entries, I just want to refresh our revenue schedule. And we now have our recognized and posted amounts the same. We've got our invoiced amount out there, and let's see what those original journal entries look like. So if we go into our journal entries, we can see here we're looking at journal entries for the end of 2021, so that first month that we posted. Now we posted two different times. We posted when we originally recognized the revenue with the invoice. So we have here our GL document ending in 1226. So that's going to be, these are all going to be the original postings. So we had an invoice out there and a deferred amount for the amount that was remainder on the invoice when we invoiced it up front. Then that same month, we came back and we posted another entry ending in 1227, where we reversed that 5,000 amount out. So now we have an unbilled and deferred. So we're going to see what that looks like when we take that original 5,000 unbilled out there with the invoice that we've reversed and what that looks like this month. So we can see now we have our receivable amount out there. Our unbilled for the 424 actually gets credited, and then we're able to recognize that 424. When the deferred amount to the 400 and our invoice correction of the 1250. So we can see that even though the invoices affected the postings that come and are generated from SAP Revenue Accounting and Reporting, they don't actually affect the revenue that has been recognized. Now I'm going to turn it over to my colleague Jacek. Jacek, if you would like to make a couple comments on how the changes in billing affect revenue accounting for some of our customers that we've seen today.
Thank you, Sarah. So let's take this functionality in a context of a business scenario. Why would we want to do this? Well, if you're a business that deals with customers that could have liquidity issues, perhaps this is advantageous to both you and they, where on their side, they obviously are not facing a large payable, and on our side, we're not creating a large deferred revenue or contract liability balance, especially where there might be issues with collectibility down the line, or maybe we're looking at a possible contract modification on reduction of value. Again, if you're dealing with customers that are in businesses that run on such a maybe slim margins, that could be a scenario that you face more than once. Of course, one thing we need to look at here is that RAR creates these balances at the time of issue of the invoice. That is the deferred revenue or unbilled receivables setting in a functionality. RAR is capable of also doing this at a contract level for contract liability, contract asset functionality. However, those values would impact the balance sheet at the time of invoice due and not at the times of invoice issue. What we presented here is the invoice issue setting. Finally, before RAR, this was an exercise in Excel when you had to change your billing on your transactional side, such as SAP SD. Then revenue recognition team would have to have come in, done a whole bunch of jumping through hoops to adjust the numbers for the end of the month or end of the quarter. All of that goes away with RAR. RAR automatically adjusts based upon the transactional changes. In our case, we saw the cancellation of one billing and reissue of another. And the separation of a transactional system, the sales and distribution side, where you have the order and the billing, versus the revenue contract and calculation and posting of deferred revenue and unbilled receivables or contract asset, contract liabilities numbers, that separation allows you to control and see the difference and separate the two processes with little complication. Thank you, Sarah.
The second scenario deals with a contract combination, including currency exchange issues.
Now in this scenario, we're going to be looking at a contract combination done in a foreign currency. So here we have a 2-year contract in a non-local currency. We're going to be using the British pound that has already started recognizing revenue. The customer decides that they actually want to add on a contract within the same local currency. And we're going to show how the system can combine all the performance obligations from both of those contracts and show the revenue allocation prospectively.
Here, we're looking at the original contract we had with our customer. So this contract only had one performance obligation. It was a 2-year contract with the customer. We are looking at it in the local currency of the British pound. So we can see here our fixed exchange rate is going to be the method that we're using. SAP Revenue Accounting does handle both the fixed exchange rate and actual rate. We can talk a little bit more about what that is later, but just know for this particular contract, that is the rate we'll be using. If we look down, we can see our performance obligations here. For our one performance obligation is going to be time-based over the next 2 years. With this contract, we can see that we have already started recognizing revenue. So with this one, we started recognizing revenue in January of 2022. That has already been posted. And then what's going to happen is the customer decides in the next month of February that they actually want to add on some items. Rather than make amendments to the existing order that's out there, they submit another sales order with new items. So we can see with these new items what that actually looks like for the contract starting in February of 2022 going out another 2 years, and how that's going to be affected because the customer has made very similar sales orders within the quarter. We are actually going to combine the two. So let's take a look at what that looks like. So we have our new order with the same fixed exchange rate method. We've got 2 performance obligations now. If we move into the revenue schedule, we can see starting in September, we can start recognizing our software and our service. So what we're going to do is the system can automatically combine these contracts, but I want to show you how you can also go manually into revenue accounting and make those changes. Based off of the information that you give on the sales order and how you would want to combine these contracts, a lot of our customers are already doing that automatically, but this is going to be the best way for you guys to see how we capture those 2 contracts and bring them together after they have already been created. So the type of contract combination we're going to be using, we've got contract modifications as well as change of estimates that we could perform here. I'm going to be using the change of estimates in the earliest open period. So because we had some open periods from January, that's when the effective date will go into effect, and we'll be looking at the changes to the contract when we take all of the performance obligations from both revenue accounting contracts and combine them into one. We are now left with just one revenue accounting contract, and it has deleted and saved the last contract that we had with our performance obligations. So if we go take a look at our new revenue schedule, here we can see the posted revenue that we already posted for last month for one of our performance obligations. And now we have in February a revenue that we need to recognize for the original performance obligation as well as the 2 new add-on performance obligations. So the new allocation is automatically done based off of the rule framework. So there's nothing that needs to be reallocated. The system already handles that for all performance obligations involved from any operational document. So we can see with our 3 performance obligations from 2 different operational documents, we have new allocation and new revenue that will need to be posted in the current open periods. So if we go in and post our revenue, this is where you're going to see all the performance obligations that came from the first revenue accounting contract into the second revenue accounting contract that were fully combined were all done in the British pound. And the system automatically shows you here in your postings what that's going to look like for the transactional currency as well as the local currency or group currencies. So you can see in real time what that amount is going to be. Then we can focus in on our reporting. Our reporting also is going to show us what we're going to have for our revenue in British pound, as well as your local currency in US dollar, as well as showcasing what that fixed exchange rate is if we were to go into our financial document and look at the header there. We can always go back and see what that amount was. And now I'd like to turn it over to my colleague Jacek. He's going to add a little bit more color commentary on what we've seen with our customers, both from a contract combination standpoint as well as how they're utilizing revenue accounting for foreign currency contracts. Jacek?
Thank you, Sarah. And here again, let's put this functionality in the context of a business scenario. This is a contract combination that revenue teams and many customers see themselves doing at the end of either a quarter or a fiscal month. If you think about it, your sales teams that operate upstream ordering and billing systems would create multiple contracts with customers with different billing schedules for different materials. However, as we know, under 606, when contracts are related in nature within a certain span of time and also between the same parties, they need to be combined as one revenue deal, one revenue contract with an end customer. So here, that is exactly what we are doing here. We're using the RAR functionality of change of estimates, which is a retrospective combination, to combine multiple upstream orders into one revenue contract with our customer and creating a new allocation structure. Now, the retrospective or change of estimates functionality allows us to calculate cumulative catch-up, which will go back to the first day of the earliest open period, in our case, January, as you saw during Sarah's presentation. So again, this is what revenue teams do all the time. As sales comes in during the month and create multiple agreements, the revenue teams usually look at the particular transactional orders that were created and make decisions whether particular orders need to be combined into one revenue contract under 606 guidance for disclosure reporting as one revenue contract. And that is what we did here. And as an addition bonus, you also saw that these revenue contracts were not in local currency. They were in British pound, whereas we are, for the purpose of this demo, our local currency is US dollars. The system settings of fixing the exchange rate works at the POB level. And we saw two contracts which were created perhaps at different dates have locked in different exchange rates for themselves based upon the creation date. So to put that in other words, if we had 4 performance obligations, 2 from contract 1 and 2 from contract 2, those contract being the operational contracts, we kept the exchange rates which were locked in for the first 2, and exchange rate which was locked in for the other 2, and then we'll continue using those to post from the RAR tool. RAR tool allows you to fix the exchange rates, which has been a way that numerous customers have used FX in the past with SAP functionality. However, we could also switch that to what's called an actual rate and allow RAR to look at the exchange rates as event happens. So as your exchange rates for the other currencies changes from month to month, RAR could use that changing rate to post and create catch-up postings to make sure that you are always in balance. Thank you.
The third scenario explores the process for handling a superseding contract.
We are looking at a superseding contract scenario. So for this example, we have a 1-year contract with a customer. They are looking to make a change to that contract. What's important to note here is that rather than augment the existing contract, they actually want to create a new contract with the new changes. So instead of changing our 1-year contract to a 4-year contract, we're actually going to close out that original order and create a new contract with the new terms. This specific scenario, where the 2 contracts are related, shows that SAP can combine them into revenue accounting so that the finance team also has full visibility into the history of these changes. Here we can see our original 1-year contract with the customer for a piece of software for $1,200. We can see in our revenue schedule that over the life of this contract, we'll be recognizing $100 a month for the next 12 months. So we've already started recognizing revenue for the first period, but the customer decided they wanted to make changes to that existing order. So from here, we can take the revenue that has already been posted, and that will not change. That revenue will always be there, but we have to close out the contract so that we can see the changes going forward. So we go back to the original sales order with the customer and close it out after the end of this month so that we can create a contract with new terms. So if we go back to our revenue schedule for our contract, this is going to showcase how the revenue does not get changed for revenue that has already been posted. So we are removing the expected revenue for the rest of the 1100 from our revenue schedule. But once we refresh, anything that has already been posted will stay within the revenue accounting contract. Now I'm going to show you here a new contract with the customer showcasing the start of February of 2022 going through the existing 4 years to showcase how this customer can take an original order and the order that they have modified to meet their needs and how they can reflect those in one revenue accounting contract. So what happens is we will take those contracts, we will combine them into one financial contract, and you'll be able to see here we have multiple operational documents, multiple performance obligations, and then when we get into our revenue schedule, that's where we can actually see the combination of the revenue that has already been posted from our original order and then the future revenues for all of the existing performance obligations that we have on the new order. And now I'm going to turn it over to my colleague Jacek to help us understand a little bit more about why some of our customers are utilizing superseding contracts and how they're utilizing those within SAP.
Thank you, Sarah. So let's put this functionality in a context of a business scenario. Why would an RAR customer, an RAR user, want to use this functionality? Well, think of a separation between the RAR system and the revenue contract, the ASC 606 picture of the world that RAR creates, and the transactional systems that create your contracts, your sales contracts with your customers. So the systems that tie to actual legal documents, paper contracts, the agreements themselves. Here you see that a transactional system change, perhaps a change in terms of conditions, necessitated a closure of an old contract document and creation of a new contract document. However, under AC 606, the rules state that related contracts that are related in subject matter as well as timing, as well as the parties involved, should be combined and considered one revenue deal, one revenue contract. And RAR allows you to do exactly that. We have two contracts which are created upstream, one which was ended earlier and then replaced with another. Yet on the side of the RAR tool, we see those two documents being combined into one revenue contract. So the ASC 606 picture of a world, the requirement to show that one collective deal and the performance obligations within it stays whole and allows your revenue team to report on that. Again, the separation between the transactional systems and the objects within that, so the contracts as we think of them, sales orders and billings, versus the revenue contract within the RAR tool, allows you to do that and allows the two structures to be managed independently.
We hope you have found these scenarios helpful. For more information, visit bramasol.com. Thank you.